Hello, this is Pat O'Meara. I'm the chairman and CEO of Inveniam, and we're excited to have this podcast where we're joined by a number of our great friends talking about private credit, the expansion of private credit, and how that is, morphing into, because of its scaling, more like public credit. And this is a big part of the growing economy. As private credit is lending more and more, and technology is going to be a transformer of it in many different ways. And we're excited to have these wonderful guests to discuss this with us. So Rick Bunker, who's our CTO, is with us. Kevin Cutterback, our chief data scientist. Albert, who runs our AI division. And we're joined by four of our great friends, Shari Noonan at Rialto. Shari, give us a quick introduction of yourself.
Hi, thank you so much, Pat. Great to be here. So my name is Shari Noonan. I'm the CEO and co-founder of Rialto Markets. We are a FINRA member broker-dealer, and we operate an alternative trading system across all private markets in digital form as well as traditional form. So we're really looking at being a critical component to the market as it scales and creates new product in the private space.
And Shari, you're located in New York City, is where, but you operate much of the time out of Florida. Is that right?
I do. Sunny Florida.
There you go. Julian, we're going to go to you next, my friend. Thank you for joining us. Julian is joining us as the latest time zone, and we appreciate you staying up late to be with us. But Julian, tell us a little bit about yourself.
Hi, Pat, and thanks for having us. My name is Julian Kwan. I'm co-founder and CEO of two platforms in the real-world asset space. Investax started as a real estate crowdfunding platform about 8 or 9 years ago. We went full tilt into the real-world asset space in 2018 when it was called security tokens, and we added an exchange license, and now you can issue real-world assets on that platform on 7 different public protocols. It's like a SaaS model, so any investment firm can have a co-branded section and leverage all the tech and licenses and wallets. And we also built IXSwap because there's been like no liquidity in any of the real world asset industry. So we kind of embarked on a mission 3 years ago to build like the Uniswap for real world asset tokens, which essentially is like an exchange that allows anyone to start a liquidity pool that has an equity token, but it does it with securities licenses and custody licenses. So thanks for having us. Look forward to the discussion.
Wow, fantastic. Thank you, buddy. We have been in contact and watching Julian from the early days, and he is a grinder who has been building through winters and summers and springs.
Yeah,
and it's awesome to see your success right now.
Thank you. Appreciate it.
David, thanks for joining us, brother. Give us a quick introduction of yourself.
Sure. David Wagner, Houlihan Lokey. We're a very large publicly traded investment bank. We sound like a sort of total traditional finance, and in many ways we are. However, we look a lot at the markets, at what our clients are doing to respond. In particular, I sit in a valuation business, which is part of a valuation and advisory role. And we look and say, hey, markets are changing. How are you going to react? What's the technology, the workflow, the process, and then the opportunities that come along with this changing market? So that's where I spend most of my time.
David, great to have you, brother. Thanks so much. John, talk to us a little bit about yourself. Tell us who you are and also a little bit about G42.
Sure. So thank you. Thanks for having me. I'm John Nieman. I'm head of investments for G42. We're an Abu Dhabi-based AI and pretty much all things digital conglomerate. That has started really with about 22 people in 2018. We're now over 22,000. It's ridiculous levels of growth, but very exciting company. Before that, I was with Adia. I was within a group called Emerging Opportunities, where we did eclectic and emerging new investment categories for a very large sovereign wealth fund here in Abu Dhabi. Was head of private equity, co-head of private markets for Saudi Aramco. And before that, State Street Bank helped launch the State Street Private Equity Index there. and was part of the private equity program at the state of Michigan retirement systems. So thank you very much.
Hey, and John, really, it's fantastic because you've been in the private markets business for a long time, right? And looking at what early days of decision science and big data and just running Monte Carlo analysis after Monte Carlo analysis over expected returns and looking for opportunities in private equity, and been investing in AI for years, right?
Yeah.
Talk a little bit about that, right? You've been investing in AI for years, and you recently had some big announcements, right? Microsoft just invested 1.5 billion into G42, but talk about not only the history of you investing into big data, AI, ML into private markets, and why is this big transformation happening now?
Sure. No, absolutely. So there's a lot there. I'll try to skip to it, but I stumbled into private markets in 1994, and almost hate to admit that, because that's a long time ago. That obviously was an emerging asset class then. A lot of these subsegments of private equity, venture capital, et cetera, all of it was new. And I was intrigued with that, even as much as being intrigued with the asset class in general. Skip ahead to the state of Michigan retirement systems, which I was there about 20 years ago. That's when I first saw the power of big data. We didn't even have a name for it. It was just our portfolio of 300 funds from a variety of disciplines, allocations, regions, et cetera. But just harnessing that data, utilizing that data, and then being introduced to people that were using private equity data historically to run Monte Carlo simulations, as you mentioned. At that point, the rating agencies required 100,000 iterations of a Monte Carlo simulation in order to obtain credit-worthy, rating-worthy data that they could rely on. That would take the processing on that would take 72 hours or more. But that's when I really started to look under the hood and see the power of what was going on beneath and in these different subcategories of private markets. I tried to take that to State Street because I saw the advent of, we created the private equity index for State Street. So I wanted to, let's make it tradable. Let's make it, that's what State Street does well with, right? With SSGA and ETFs and whatnot. I thought if anyone would get it 20 years ago, it would be State Street. But unfortunately, it was a little too early, a little too crazy then. Fast forward again, 10 years ago, building out the private equity allocation for Aramco, I invested and was fortunate to catch Goodwater Capital right in their formation. I did their Fund 1, 2, 3, 4, and since, and Stripes Group. Stripes Group, I did Fund 3. And again, both of these were, as far as I know, the first to utilize what's now AI, then it was called big data, utilization of AI to basically map out adoption curves. So if you can map out adoption curves sooner than you can your competitors, in the case of Goodwater, it gave them 1 year of advantage to be able to see deals that otherwise wouldn't have hit the desks of their competitors for several months or a year later. So they could go in and walk in with more data than the CEO of that company had, and I saw the power in that and the ability to harness that. Fast forward again to Adia. Adia asked, I think it was week 1, as being the new guy. This was 2018 now. Blockchain and crypto were becoming a thing, and they were hitting the different desks of our various groups within ADIA, and they said, hey, can you look at this blockchain and crypto stuff? And oh, by the way, can you look at forestry for us? Well, one is very much not like the other. And so beginning to frame up and think about, okay, what is blockchain really? And what is crypto? And I already had this burning desire to do AI applied to private market investing. And so seeing the power of fusion between blockchain and what it could afford in various iterations, along with AI, properly aimed. You have the guardrails, you have the proper frequency, the ability to split under the hood, so to speak, to get and better inform AI in a way that I hadn't thought of before. And so that light bulb went off. Unfortunately, again, it was, I think, a pretty good idea, but too early for the leadership that I had at that point. And so, anyway, at the risk of prattling on, I'll pause there, but is that what you were looking for?
It is, and it really sets the stage for private credit, right? Private credit has exploded, right?
Yes.
And I am going to go 1, 2, 3, David, Shari, Julian, with the same question, right? Private credit is exploding. The amount of money being lent is huge, right? What does it look like for private credit who is used to managing these deals one at a time and not at scale without the systems that banks have been forced by the OCC and FDIC to put in place? And it's scaling so fast without the obligations of public credit or banking, right, as far as data. And so it won't scale without throwing bodies at it unless you're using technology, right? And this technology is to administer it, David, Shari to syndicate it, Julian to distribute it. Do you know what I mean? And what I'd like to do is kind of just kick over everything. We saw technology and the early adopters create in these various asset classes that John was talking about an innovation edge, right? There's going to be an administration edge by adopting fintech, as well as a distribution edge and a syndication edge. And so David, Shari, Julian, let me just go 1, 2, 3. I'd love to hear your thoughts about this. David, I'll lead off for us.
Sure. So I'm going to focus a little on what happens when you look at a portfolio of private credit in a way that you can compare reasonably well between assets. And and that predicate, compare reasonably well, is one of the hardest things to do in the first place. Private credit assets, not standardized. I mean, sure, we all know what EBITDA is, but it looks different in different ways, presented in many different places, and it's hard to get out of PDFs if that's what you receive. So the whole concept of first bringing this data set in, and as a valuation agent, we're looking no longer at one at a time assets, but at portfolios of assets, and speeding up the process of understanding where that portfolio company is, what is the value of the loan or the equity associated with it, and then how does that fit into a portfolio? So our clients are asking us, hey, that's great that you produce valuation reports one at a time, but could you actually do surveillance on my portfolio? Tell me what the outliers are and why. And by the way, could you do it a whole lot faster than my people are doing it now by just reading all the documents you guys throw at us? So from an administrative perspective from clients, the cost of admin has to shrink. The ability to scale businesses up in private credit is being curtailed by this idea that you have to have a lot of people looking at a lot of individual documents. So we need scale in the data, but they also need either their own systems or third-party systems who can look across portfolios and at the other unobservables in private credit. We've talked before that one of the things Houlihan did was put out a private credit index so that you can see what current yields look like in performing credit. And you can break it down and look at it in a variety of ways. What we've been showing clients is that you can use that same approach across large portfolios and look at your own portfolio that way. And then do all of those, if you think about the life cycle of a private credit asset, do all of the downstream work using that same data set and give that same data set to your vendors, right? So integrating this one source of truth all the way down the line speeds everything up. You can look at portfolios across, horizontally across your business and potentially others if you can anonymize properly. And all of that makes these assets look more like public debt, which you can compare, trade, and make trading decisions on the assets. So if that's an answer, that's where we're headed and what we see.
Yeah, and I just want to add, right, for private credit, much of the time their data repository is Outlook, right? Because all the data has been emailed back and forth between people. And when Shari Noonan leaves Houlihan Lokey and goes to some lesser firm, I won't even name other competitors, right? And she leaves, and she's been covering it. Literally, that information is sitting in a deactivated Outlook that people have to go back and to look into, right? And that data normalization function itself is a huge problem. And unless you're using a mechanism that allows for a distributed or a federated data environment, and you're using AI, this creates massive scale regulatory litigation problems down the road. And and we got to get out of this bilateral data. And without a good data, federated data structure where you're pulling data and you're monitoring or surveilling data real time, you can't do it. And that leads to these syndication issues, right, Shari? Right, as we start to do it, I'm going to turn it to you.
No, absolutely, and great follow-on. So thanks, David, for talking about the data, because really the data is the prerequisite to be able to scale anything. If we think about how other products in capital markets have gone and been able to be cost effective all the way down to the retail, unaccredited retail level, it requires certain prerequisites, and data is certainly one of them. What we're seeing is really a pull from both sides, both the issuer and investors. On the issuer side, they're looking to access new distribution networks, right outside of where they typically are syndicating their trades down to middle market, accredited, even unaccredited retail investors within a suitability framework. And so that's what we've been building out and what we really focus on. And it's fascinating to see then from the investor side, they're really looking at, where is the growth in terms of my portfolio? How can I get access to these, non-correlated assets or other assets to really make my portfolio a whole portfolio? So we've been really at the center of that. And we're seeing, some of the biggest firms really try and figure out, they don't have those established distribution networks, how to create those distribution networks. And then from the distribution network perspective, how to maintain that regulatory box, right? And make sure that everything's being done in a compliant fashion, because clearly some distribution networks are used to interfacing with a completely different market that has, a central clearinghouse in the middle of it. And this is, inherently not part of the private credit ecosystem. So how do you build that entire infrastructure? And we're working on that, and obviously plugging in data elements from Inveniam and others to be able to provide the information for the selection criteria.
Yeah. And I think that, Shari, that I couldn't agree with you more on everything except when you said "and others" after you used Inveniam, right? Which just seems like that's.
Well, no, I didn't mean for the data
right?
element, for other elements.
The other, there you go. And Shari, I think that this really gets to this distributed global economy where we want to get things trading on multiple exchanges. We want to aggregate liquidity across silos, right? Not just build one big silo. And I think that goes directly from you running an ATS in the US to Julian, who's running a marketplace in Singapore. Talk to us from your perspective about what distribution means. How are we going to connect these things, and give us your view on this?
Yeah. So I think in short, if you go back to 2018, with the beginning of kind of the real world asset space, which at the time was called security tokens. From the first couple of years, it was very, very kind of TradFi focused. There was a lot of people building on private chains. There was a lot of closed walled gardens. I mean, even today, the BlackRock news is amazing for BlackRock and BlackRock investors. The rest of the world, they kind of buy it, right? So I think the big change in the last 18 months has been that no one in crypto cared about security tokens until there was a meltdown in 2022 and there was no yield. So ironically, the people that didn't want to come out of stable coins other people thought, let's tokenize treasuries and money market bills, and all the stablecoin guys can earn some yield. So the guys that didn't want to come out of stable coins into fiat started buying, basically fiat-based investments. However they got there, that's what brought the crypto world into security tokens, and somehow it got rebranded real-world asset tokens. So, but one of the most important parts about that, first of all, the crypto community really got on board. This is all high-level kind of statements, but the other important point was it was real issuance. It was a real issuance of assets on public chain, and the only way you could buy it was with a public chain issued stablecoin. I don't know if there are private chain issued ones, but anyway, the point was it was the real use case. So the point of this story was that we've come to a point years into this development. It's only been about 5 or 6 years for this whole industry, but where now it's become very obvious to Larry Fink and Jenny Johnson, all these other people are like, you must issue real world assets on public chains. That's where the innovation is. That's connection to DeFi. That's connection to crypto. That's where we're here doing it. That's where the engineers are. But like before they said it, no one else really got on board. But they've kind of planted the flag, and everyone's like, oh yeah, it makes a lot of sense. We were saying a long time ago, but everyone thought we were crazy. But the point is now that
people still think we're crazy. Just so you know.
Still think we're crazy, yeah. And so, but the point is that all of this is meant to make some sense. And the point is that the real exciting part about this, because I think we've heard from the professionals who work on origination and the actual the delivery of the product. And when I come from is like using tokenization to create completely new distribution channels. And the point of all this is that now you have all the big DeFi players, or not all of them, a lot of the big ones, crypto DeFi, moving into the space. So Coinbase is building a real world asset exchange in Abu Dhabi. They're one of our investors. We're speaking with Coinbase Asset Management. But the high level the position is, if you think about it, like what banks did with millions of customers, they eventually start selling them all these other things, good or bad structured products and insurance and all this. So what were the crypto guys always going to do? They were going to try and find more assets to sell their users. The most obvious and bigger asset class is real world assets that can add to all the altcoins and crypto that they have. So the real important point, or the most exciting thing I think happening now, apart from all of the inefficiencies and all of the other points that the speakers brought up about why tokenization of private credit is better than paper versions, is that you're going to see these assets on Coinbase. You're going to see them on interactive brokers, on fintech platforms like Grab Finance, which is the Uber of Asia, but it also has finance, and they've started selling crypto. And then all of these called captive money managers, like private banks and wealth managers, they're all started selling crypto. They're all now going to start putting all these private credit assets on, as long as they're coming in, on public chains. So I think the distribution channels are going to explode, and that's what I'm most excited by, because I think the asset class is killer, and it's only ever been available, of course, to all the rich people that understand all this stuff and have the banking contacts and all that. But the distribution channels, that's where it changes.
And I think what we're trying to highlight, particularly in this discussion, is a trifecta, right? That there is a market that has demand that can receive. There is a growing new business, private credit, that cannot do, their existing administration. And the adoption of AI, the adoption of blockchain, right? And the data repository, what is in the cloud, what is in on-chain, how do we use zero knowledge proofs, how do we access that? And the connective tissue between the big data AI, the blockchain, the tokenized distribution and fintech world as the connective tissue where Inveniam is connecting all these things. If that flywheel starts spinning from both ends instead of one end, man, all of a sudden we're going to see this thing to just really start to fly. Go ahead, David.
So Julian, I'm nodding as you're talking, and I'm thinking, yeah, he's right. And then sometimes I walk back into my fairly large investment bank with all my corporate finance bankers who essentially say, yeah, maybe someday. And by the way, the information that would ultimately be unleashed to all of in this retailization, let's call it, is anathema to all of our GPs, and our GPs want to hold that information pretty tightly. So there's a huge natural tension around information that distribution's asking for stuff, but the product creators don't necessarily want to do it. I think what breaks that logjam is appealing to their natural instincts and saying, you can scale your business up by 10 times, 10 times AUM if you build a good data pipeline so people who are buying this thing in retail really understand, can compare, can have an advisor help them through how to do selection of assets. And none of that is possible until you start giving up your data in this standardized way where it can be compared and used. And I think that what you have to get to the GPs and let them know that the balance is between huge AUM and giving up information. And when they start to see that and hit that tipping point, then I think your business, Julian, takes off.
If I could interject, David, I agree so enthusiastically with what you said. And the dearth of information about these investable securities stops any broad distribution dead in its tracks.
Yep.
But the trick is, you don't have to go all the way to the public markets where you disclose everything to everybody. What we've built and focused on is collecting this information and structuring it to make it use and accessible to many different parties, but with complete permission control.
Yeah.
So you can show it only to people after you know them, after you know they're qualified institutional buyers, their quibs if that's the case, or accredited investors
or AI.
Whatever.
Yeah.
You set up the rules, and you also keep track of who saw it and when, so you have all of that protection, knowing that disclosures took place.
Yep. And I think GPs need that story because unbridled loss of information would be that's a very bad thing. But this sort of controlled distribution of information that creates a distribution channel into retail, that appeals to their sense of increased asset management fees.
Hey, David, I think we can see who the early adopters are going to be right along the lines of what Clay Christensen wrote, right? And I keep going back to him, right? What does an early adopter look like? Because when you have professional middle management overseeing a franchise, they are optimizing processes. They're not determining, are these still the right processes? You know what I mean? And the reality is, when you have founders who are building big new franchises, they're saying, we need to go into a new process. We need to rethink the fundamentals of it. And if people think, we're working on a project right now with a many hundreds of billions of dollar alternative asset manager, and we've been working with them for years, rethinking their data. And we just kicked off, and we said, let's go. And their team came back to us and said, let's shoot for a Q3 2025 launch. And you just go, that's insane, right? Like the whole world's going to change by then, right? Meanwhile, Coinbase is saying, can we get this listed on Tuesday, right? Like, and you look at the speed of adoption, and this is where we need to say, who are the early adopters? Who are going to drive the change? And as an early adopter, what competitive advantage? And if you say, I am going to use data as my competitive advantage that I have milked for the last 40 years, but oh, by the way, I can go get ChatGPT and I can throw a ton of data into it and with Inveniam give attribution for it, right? Or I've got OpenAI, I've got huge processing power, I've got, commercial products that G42 with Inception is pushing out there, right? You look at these things and you just go, do you really think that you are going to have a processing and data advantage over what these new AI tools that are going to, and you're going to be able to continue to perpetuate your franchise? Like you're fighting a tide that's just so big. You know what I mean?
Yeah. So Pat, what strikes me, during this conversation is sometimes innovation, most of the time actually, innovation is driven by new functions that are possible and new possibilities that are opened up. But sometimes innovation is driven by new control mechanisms that make an old technology useful. So rockets have been around since the 13th century in China, right? And a pretty simple concept. You had a combustible substance and you pointed it at someone you wanted to blow up. And that's pretty much how they were for a very long period of time, hundreds of years. And over time, very slowly, we started getting better at guidance systems and all that stuff. But the real innovation happened when an enormous amount of effort and ingenuity was applied to keeping a rocket under control. And all of a sudden, it became useful for space travel because you could put a person on top of a rocket and not have them explode along with it. And that is kind of how I see the way that blockchain and AI are interacting. When you're just talking about blockchain controls and immutability and data ownership and all that, you feel a little bit like a guy selling airbags to carriage drivers. It's just like, well, what doesn't really not necessary. But now when you say, okay, AI can only get to 95% accuracy out of the box without anything else, not good enough. If someone who works at your company makes errors 5% of the time, they're going to get fired pretty fast. But if you tell them, look, all these controls are the thing that will make AI applicable to your business and get you to 99% accuracy plus, all of a sudden, both technologies become a lot more useful and a lot more desirable right then.
Amen. And I want to go to Shari and Julian. Talk to us about the scaling private credit. Right? David was talking to us a little bit about the administration and how asset managers need to understand this. Albert saying, okay, we're going to overtake, we're applying the airbag to the Lamborghini, not to the carriage, right? What is it going to be that is going to drive private credit onto your exchanges, and what is it going to take for your buyers to want to buy it in a manner that we're going to start seeing private credit trade, and what are the data obligations we're going to have if it does go there, right?
Yeah. So maybe I'll kick that off. And one thing that I was thinking through as Albert was speaking was really in the US, what we see is happening and why fund managers and others are approaching us from an issuance perspective is they see from mass, retail, whether we want to call that unaccredited, accredited, or up, those distribution networks are changing. Traditionally, it was through the wirehouses and product got pushed out. Now everyone's, Robinhood, Webull, other alternative investing platforms, they use their self-directed IRA. And so all of these other distribution networks have popped up, making product accessible. The challenge is, how do you get that product on there? How do you get it on there in a compliant fashion? But that's why fund managers want to work with us to push it down retail rails, because they're different retail rails than they've ever been able to access before. And fundamentally, the generation with the wealth transfer that's going to be happening over the next 12 years is not going to be that, you invest in the same way that the generation today invests. And so we need to open up new distribution networks and new ways for them to get to that product in a compliant and regulatorily appropriate way. So that's what we're seeing in the US, the beginning of fund managers coming to us and on private equity and private credit, but I'll go back to private credit in just a second and say, I need access to those new distribution networks. On the private credit side, what we're seeing is not just going down to retail, but even, middle market and allowing middle market firms to be able to avail themselves of due diligence that's been done by some of the largest firms and then, syndicate that out and allow them to participate side by side from an economic perspective, while the really large firms have the lion's share and, have the governance rights as well as economic rights. But the middle market firms are happy to participate from an economic perspective because they don't have the due diligence capacity to be able to thoroughly do that diligence on some of these deals. And so that's what we're seeing from the syndication perspective is really using technology to be able to enable that entire flow and just bring the trade size down in a cost-effective way, which I think is, the only way it scales effectively.
Julian, are you seeing the same thing?
Yeah. Well, so I think 2 touch points. I think what's super interesting about private credit and, all private assets, private credit's a great one because the returns are, as an asset class, the returns are very high, risk's low, risk adjusted. It's very attractive. What we've been pushing into the kind of the TradFi space of like private banks, wealth managers for years and saying, well, your business models are basically your fees are on a race to zero. You're holding on to these high net worth clients. The next generations of these families and whatnot don't want to pay you money for these services because they can do it on their phone, right? And so actually, and the margins that you've been able to achieve are shrinking because you're all just selling the same public traded assets, and that's the way it's been. If you start selling private credit, tokenization, real world assets, you have a whole new world of asset class. You have the way to generate new revenue that actually offers a lot higher fees. First of all, if you just need to get these attention, you say way higher fees, right? 100 basis points, 200 basis points, 300 basis points, make insanely more money. If that doesn't get you off the seat, and the next part is like you're staying relevant. You're actually producing products that your clients need help understanding. So you're back in the relevant game. And like the reason why you only traded and sold mostly publicly traded assets, they're digital, they're tradable, you can see them. That's what happens now, with tokenized assets and real and private credit. So it just ticks every single box, from making money to staying relevant to actually opening up new markets to everything. So that's the TradFi side. So funnily enough, it's taken them a while to get it. They're all starting to get it now, but they're finally getting it. And then the other flip side is the DeFi side, which I've mentioned, before, which I won't sort of repeat again. But that's like the concept is open your phone, interactive brokers, Grab Finance, Coinbase, whatever, and just buy your assets, right? And this asset class in particular is one of the, I think, personally most attractive. If it's all on tokens on the same rails, you see that go. Like, just as the last point, without taking too much time, Tether has done a partnership with Telegram. I was speaking with those guys in Dubai. There's 850 million wallets in Telegram, nearly 1 billion wallets. They now got crypto. All they need is partners like us and other people here with license and whatnot. RWAs go up on those platforms. Billion users overnight. It's not. They're the numbers, and it is literally overnight. That night might take some months or years to prepare, but the day they launch, then it's there, and that's the exciting part.
And Tether, who is, throwing off enormous cash flows right now, right? $80 billion that they're sitting on, that they're collecting the interest, right? The carry trade is one of the great trades of the world, and Tether's got the carry trade for crypto, right? And they're literally holding that money overnight or for whatever that period that it's invested, getting that as they're holding $80 billion on behalf of the Tether world. And I don't know whether it's 80 billion or 100 billion. The number I have is probably wrong by 20 billion because it's 3 months old, right? And all of a sudden, they're throwing off, and they're talking about putting $1 billion a year that they're going to deploy into infrastructure, right? That from their earnings, and you look at that, and they're just enormous numbers. And I want to throw this to you, John. One of the whole I guess theses of what you've been doing for the last several years is identifying these opportunities, right? And saying, where is the puck going, and how do we invest for that now? right? And you've been looking at AI, you've been investing in AI at G42 for years, right, at scale. And how is this AI plus blockchain connectivity going to transform private markets and private credit per se, right? What's your view on this?
Yeah, no, it's great. It's a great question. Thank you. And it touches on, you have to kind of go back to the fundamentals really to stitch it all together, because that's what led me down this path, was the pain points in trying to do something different in a pretty established organization, Aramco, ADIA, you can imagine. So when it comes down to it, it's liquidity, transparency, and regulation. That's what we're offering, right? The right level of transparency, the right level of liquidity. You want someone on the other side, and you want the proper guardrails for regulation. So it was in that kind of problem set that I was trying to solve for, doing something new within Aramco that didn't quite fit the traditional parameters. Caused me to, I recall having a conversation, with Josh Lerner from Harvard. And I said, well, what is, because IRR versus time-weighted return, for instance, and without getting into all of it, we had this fundamental conversation, philosophical conversation of, what do you ever have pension and investment firms just solely measure in IRR? Why time-weighted? Why is public markets? Why is that the fundamental underpinning for our whole financial system? Who says that is, and I've had this argument with a number of actuaries too, who says that's the right underpinning? Why isn't it private markets and then subtract volatility in order to come to the, so why, these were the fundamental, and his answer was phenomenal. He said it's 1965 in these alternative assets. There's not the proper systems, the proper reporting, the proper mechanisms. And you think about our whole financial system was set up really with the regulatory system, the accounting methodologies, the valuation methodologies. It was all set up when tangible assets accounted for 85 to 90% of the value of the S&P 500. Well, now it's inverted. And so I love the question that someone threw out about intangible is, you have these more mixed assets that are crossing the lines, or you have things like intangible assets, ideas that used to be just plugged into goodwill and forget about it. Now, what do? Software has been made an exception, but you have so many other areas of intangible asset value that can't be accounted for. And so it was kind of in that stream of thought that caused me on the hunt to say, okay, what's the answer? I saw blockchain. I said, okay. I went so far as to explore patenting. It's already patented by IPWE. The whole income statement, balance sheet, put it all on the blockchain, because there's elements, in royalties. All I'm interested in is the top line. All I want is exposure to the top line, and give me as much exposure to that attractively, in a diversified manner, in a transparent manner, in a liquid manner, and in the proper fractionality. I guess that's another one that I'm attracted to. So it was kind of with this mindset that led me down the path. Now, private credit specifically, same thing. You have various high yield bonds. Yes, it's liquid, great, but it's more thinly traded than many of the private credit instruments. So What's the advantage to that? There's none. But yet that somehow it crosses the line from one area into another, and all of a sudden that's the validation for certain asset owners.
John, if I can, and I hope that I didn't cut you off there, did I? Well, yeah.
Right.
What I want to do is kind of connect this up, and there were a number of questions, right? And it is clear that when we talk about Julian in Singapore and looking at distribution and plugging into DeFi, and Shari with her ATS, who's largely institutional focused, who's delivering, also has a whole lot of retail, but is more institutionally focused. And then we've got David, who's doing the administration, and you're as a core infrastructure investor delivering AI. This answers the question that our friend at MIT was asking that was put up on there. How do we deal with sparse and granular data? The reality is there is an enormous amount of data on private assets. It's just not in one database. Right. And that is the problem. Right. And everybody's been saying in order to solve this problem, we all got to get it normalized in one database. And you're solving for the wrong problem. You have to say, where the data is going to live in a million different places. We're going to use new AI tools in order to take unstructured data, deliver it as structured with auditability. We're going to have to build better QA, right? And automated QA as well. But if we can prove that it's using this and it's a fully distributed, then the data is there. It is not sparse data. We are data rich, but it's not in one location, right? And what we're doing is saying, trying to solve it where we're going to get the data and all in one location is the fool's errand that is blocking technology from getting into private markets. So if we have a distributed data environment and we can say this and we can deliver that information real time, suddenly Julian can power a whole new line of customers, right, that are in DeFi, and he can serve this up. Shari can have a whole new mechanism for new ETFs to be created, right? New unique strategies to be delivered, right? David's administering valuations at scale, and John is delivering AI to customers that's not at the largest of the large enterprise customers only, but how does a medium-sized enterprise, a small to medium enterprise, use AI to power their processes and being more nimble overtake the biggest of the big, right? All of a sudden, the biggest of the big's process that they can throw bodies has now been made moot by AI for an early adopter as a small company. Do you know what I mean? This normalization. David, you were going to go ahead.
Yeah. Again, I'm nodding with everything except one critical link. Every private credit asset manager is enormously spreadsheet based. We have to kill the spreadsheet. We have to figure out how to incent all those organizations to stop using ungoverned tools.
Or we govern the tool. How about if we use Inveniam as a mechanism every day to drop an anchor about the state of that spreadsheet, and then look at it every single day, and all of a sudden it's auditable, it's loggable, it's no longer end user computation. And every time we need to extract data, we're not doing an extraction that we're hard coding, and we can't hard code it because it evolves and changes so quickly, right? I mean, I think about John's comment about the 100,000 iterations of Monte Carlo. Today, I can run 100,000 iterations using a macro in approximately 7 minutes. You know what I mean? Whereas back then you had to rerun. You had to run them again and again and have multiple people running it and tabulating the outcomes. Whereas today there's a macro built for it. And those macros are going to be build and develop, et cetera. And Excel we need to create the mechanism to stop the spreadsheet from being EUC. David, is that a fair statement?
Absolutely.
If any other questions, I'm sorry, I feel like I shut down conversation. Kevin, did you want to, well, and I'll throw it out there. Any other comments on that topic?
Yeah, I've got a comment. I mean, yeah, at the risk of being gratuitous on this, the exact opposite of this concept is the concept of a data lake, where you just throw everything together and mash it all. And I've always really had a problem with that concept. We are like the anti data lake. Leave the data where it is. Don't homogenize everything. It's like you're at the pasta sauce aisle at the grocery store and you're like, no, don't keep them all in individual jars, just mix everything together, and when we need it, we're going to just grab all the molecules. That kind of defeats the purpose. The lake analogy and metaphor has actually always been really hilarious to me, because you're making most of the water inaccessible to someone who just needs to grab some of it. It always was. So to Pat's credit, and Rick, it was a very difficult architecture challenge to deal with data at its source and compute on that. But it's turned out to be a very good long-term strategic choice.
I will say that the big asset managers who want to scale are attacking the Excel problem on their end as well. So Pat, although yes, identifying each day what the source of truth is would be fantastic. I do think that if not a data lake, we could create a few small swimming pools where you can identify and trust what's in that pool.
Yeah, decentralized, and there's got to be lots and lots instead of one database to rule them all, right? And I want to go to an accounting comment that you made about intangibles. We talk about private credit, and John, you were talking about goodwill, et cetera, and you said there's not accounting for it. I want to kind of push back on that. There is accounting for it. It's just horrible, right? Right? There is accounting, and it's to lump everything together and just put it in a catch-all, because again, the data is not there for it. And I think as we can begin to tease these out, and Julian, I'm going to throw this to you. If we give you enough data on any asset class, you want to throw that on your platform and give your investors access to it, right? But it all depends on the good data, whether it's IP rights, royalty, whether it's any of those things. But it's got to have data. Is that right? And then with that,
yeah, no, I look 100%. I think most of the there's been a lot of plays working on the kind of the concept of ensuring the real price of the underlying is matching the token, right? And I think that was a lot harder in what I call the security token age, which was like 2017 to last year kind of thing. And then now we're in the real world asset age where everything's actually being issued on chain. It's better. But yeah, fundamentally, for sure, I think what you guys have been working away at is a critical piece. I think it's more relevant for the TradFi side of the buying market, which is huge. I think the crypto guys are a little bit more fast and loose, and that's why they love all these crazy tokens. And at the end of the day, they a little bit more probably trusting in good platform, good asset. But yeah, fundamentally, I think that's one of the key areas of the industry that needs to become more robust, which will bring more buyers, essentially, more trust.
Yeah, and Julian, to use a horrible example, that we're not going to name names, right? But a DeFi protocol that their largest loan was to a motorcycle company in a nation that did not have good laws. They didn't know who the borrower was, and when they made their final loan, the next day, the entire inventory collateral for the biggest loan on this DeFi protocol was gone, right? Yeah. And we all know who that is, right? Yeah. And what we need to do is get that freedom of liquidity movement that will move fast to something that actually has a UCC filed against it, and that there's a low jack on the motorcycle or whatever it is, right? That there's real estate behind it, that the collateral's good.
Well, Pat, one comment on collateral, because one of the things that we've been seeing exploding is, and we call it NAV lending, where in the private credit market, large liquidity providers, banks, are lending to alternative asset managers to give them liquidity against assets that they can't sell. So the idea that that we have to be able to value, and maybe as frequently as daily, a complex private market asset requires an enormous amount of trustable data. But that is the way that regulators who are regulating these large pools of liquidity that are going to fund these collateral structures need to see it. So there may be a regulatory driven nexus that creates a need for this trustable data flow, because once you have the large regulated entities using alternative assets as collateral in repo structures, you need that full transparency.
That's so good. We're going to go around for final comments from everybody. Kevin had to drop a minute early. His comment he put in is, Microsoft's balance sheet is 67 billion in goodwill, 10 billion in intangibles versus 360 billion of total assets, right? And you just go, wow, what they're doing is this is a catch-all bucket for a bunch of things that they don't know how to value in any way that the accountants will do, because there's not enough data, and they want that data in a way that historically was not there, but we now have the tools to begin to deliver it. So let's go all the way around. And Shari, I'll go first. Any last comments on this discussion?
I would just say that it's pretty clear the size of the opportunity and what technology brings to bear in terms of being able to scale. And I think in a few years we're going to look back and see this as an obvious move into new distribution models and get these assets into the hands of new investors, which is really exciting, and I think good for everyone.
Shari, thank you. So great to have you with us. Julian.
Yeah, look, I think, obviously all the things thanks for having us tonight. And it was a great discussion, all these smart people and platforms. What you guys are working on is critical to help scale, right? I think, and what we're trying to do is everyone here is trying to scale. Well, some of us are trying to improve let's call it the packaging on the origination side. But yeah, love what you guys are up to. And hopefully there's just more momentum building, which is clear by what's happening in the space. And yeah, I think it was great to catch up with everyone here. And if we can help with anything along the way, please let us know, and happy to join the next one.
Julian, that's going to be awesome. Thank you for being with us. John.
Yeah, thank you once again for having me. And likewise, I just to reiterate, it's a huge opportunity. I liked what David pointed out, in terms of the 10x. That's what I see is these are the building blocks to help unlock a whole massive wave of AUM for the right people that capture the opportunity and recognize it for what it is. I think the early adopters here will be greatly rewarded, and I'm excited to play whatever little role I can play in it. So thank you very much. Thanks.
John, that's awesome. Thank you. David, you're on mute.
There is a gravity in markets that is going to propel us in the direction that we have talked about at this whole webinar, right? It's greed and fees. It's broadening markets. It's everybody wants a piece of the action. That's what's driving it. And there's resistance, just like a bulwark around New York City, but that bulwark will erode. New York City will move to the sea will rise, and that is the direction that things are going, and this conversation proves it.
Yeah, I could not agree more. Shari, any additional comments from you on that?
We're seeing it already. We're already seeing, the financial centers, while still being the majority, but things moving out into other centers. So I completely agree with that, David. And thank you so much for having me on. It was great to participate.
Absolutely. I'm gonna Rick, Albert, Kevin. I'm gonna give a final comment, but anything from any of you guys before I jump?
Take it away.
All right. I think one of the things that we need to be aware of is not only geographies, So developing geographies that demand investment, that do not have legacy infrastructure, are going to adopt this next level of infrastructure faster, right? And I just think, let's use real estate, let's use private credit as real estate in Asia, real estate in India, particularly, where you have massive construction and the smart buildings that are being deployed that are going to be connected real time. What's happening in some of the construction that we see in I'm going to use El Salvador as an example. In some of these second world nations that are developing at scale, that are connecting, that are smart, that are using all new technologies, and you just go, this is the future. And then you're going to have the big incumbents be fast followers. You know what I mean? Now they're doing some testing. And Julian, you talked about the big news on BlackRock today, right? BlackRock today is coming in as a fast follower on top of 8 years of innovation of the groups that they partnered with. You know what I mean? An overnight success for the last 8 years. And what we're seeing is the innovation and the building and the grinding, that we've got to continue to get these early adopters. But it really is, we're going to see some critical mass in areas. And from there, Coinbase is going to be a financial services company of the future that is going to rival the biggest banks in the world, full stop. It is. And if it continues to innovate in the way that it has and partner with people like Julian around the world, it is going to be bigger and larger than many of the biggest names that exist in the world today. It might be another one that's like it, but I think we're going to see new names popping up. And if we can deploy capital at scale in these industries that are early adopters, boy, we're going to see this revolution happening. So with that being said, that literally is my appointment calling me that I'm late for. Good to have all of you. Thank you guys for being with us.
Thanks, everybody.
Thanks so
Thank
much.
you. Thank you very much. Bye-bye.
Bye.